Welcome to Episode 5. This is a discussion of Chapter 5 of UAE Crypto Litigation, available at www.uaecryptolitigation.com.
Today, we're undertaking a deep dive into really one of the most critical challenges in crypto transactions.
Right. How do courts figure out what a transaction actually is?
Exactly. Specifically here in the UAE, we're looking at a case where a contract was styled as a simple loan, but the underlying asset, well, its value just skyrocketed.
And that's the core mission for us today, isn't it? Understanding how the courts calculate damages when a deal like that goes south.
It is. We're examining a specific court analysis that shows the judiciary is, absolutely willing to look past the label, past that word loan, to enforce the real economic substance of the deal.
So for you listening, this is critical because it's not just about getting your principal back.
Precisely. The court awarded damages for the lost investment opportunity. It's a powerful signal that they see crypto volatility not just as a risk, but as a quantifiable material injury when a contract is breached.
Okay, let's unpack that judicial analysis then. We're looking at a judgment from a Dubai court of first instance in 2021. And the facts of the case really set the stage perfectly. You have a sophisticated international investor on one side.
Right, who enters into this agreement with a counterparty, and they call it a debt agreement, which is where all the confusion starts.
And the initial transfer itself was pretty clear, wasn't it?
It was. The source material shows the facts there were largely undisputed. The claimant transferred a significant sum, we're talking hundreds of thousands of dollars, but it was dispersed as two specific virtual assets.
Which were?
Bitcoin Cash and Bitcoin SV. So the funds go over to the defendant under this written agreement.
But here's the twist. The repayment obligation was highly unusual.
Yeah.
It wasn't a standard loan where you just return the cash or even the same assets.
No, not at all. The agreement specified that the defendant had to deliver a precise fixed quantity of the main Bitcoin unit BTC on a set date in the future.
And that one detail changes everything.
It fundamentally changes the characterization. I mean, it stops looking like a debt instrument and starts to look much more like a forward purchase agreement, a speculative exchange.
So when the defendant failed to deliver that BTC on schedule, the claimant didn't just sue for their initial investment back.
Exactly. They pursued the principal, plus this massive claim for damages for the wasted gain. It was a multi-million dirham amount that came from the huge rise in the price of BTC after the agreement was signed.
That's the heart of it. How do you prove that loss in such a volatile market? This case came before the big regulatory frameworks like VAR were in place, so there was no specialized crypto law to lean on.
Right.
What legal principles did the court actually use to navigate this?
The court grounded its entire analysis in the civil transactions law. It started with the doctrine of contractual sanctity.
The idea that the contract is the law of the parties.
Precisely, citing Article 246. But what's really fascinating is the practical approach they took. Because the defendant was absent and the assets were so complex, the court had to rely heavily on a court-appointed expert.
Wait, so the court essentially outsourced the financial breakdown to an expert. Doesn't that raise questions, especially with the defendant not there to challenge the numbers?
It speaks to the pragmatism you need in these cases. The court needed an objective third party to translate all these different crypto transfers and the final BTC obligation into, quantifiable dirham and dollar figures.
So the expert's report became the central document.
It became the central and decisive document. The court ultimately adopted the expert's quantification of the principal debt, and crucially, it agreed that the legal obligation was to return that precise number of BTC units.
Okay, so that establishes the liability. But proving the breach is one thing. Proving that multi-million dirham loss of profit is another. How did they connect the dots? How did the court link the defendant's failure to deliver to that specific market upswing?
This is the most important part of the judgment. The court applied the established tripartite test for liability: fault, damage, and causality.
Okay.
The fault was obvious, the breach of the delivery obligation. Then they looked at the damage. By failing to deliver the BTC on time, the defendant deprived the claimant of holding a highly volatile, appreciating asset.
So the damage wasn't just the missing BTC, it was the missing opportunity.
Exactly. The court found that this lost opportunity, the wasted gain, was a material injury, and it was directly caused by the defendant's breach. This decision is effectively treating Bitcoin in this context not as cash, but as a unique speculative tool whose appreciation has to be compensated if it's unjustly withheld.
That is a radical break from how you treat a standard debt.
It is. It defines the ruling.
So a powerful affirmation of the transaction's true nature.
Yeah.
But when it came to the remedy, the court didn't just rubber stamp everything that the claimant asked for, did they? Like the delay interest.
No, and this shows the court maintaining strict control. The claimant wanted a 12% delay interest rate. The court rejected that, citing a binding judicial policy from a Court of Cassation decision in 2021.
Which set the rate at
5%, mandatory.
That's a big difference.
Mm-hmm.
And the court was also quite nuanced about when the interest clock actually started ticking.
Very nuanced. They drew a line between the principal debt and the speculative gain. Interest on the liquidated principal debt that runs from the date the lawsuit was filed.
Okay, that's standard.
But the interest on those unliquidated damages, that multi-million dirham compensation for the wasted gain, that was ordered to run only from the date the judgment becomes final.
I see.
The court was essentially saying, look, we know you lost the principal back then, but the actual calculation of how much profit you would have made, that speculative figure only became a hard number when we ruled on it. So interest on that part only starts now.
It's amazing that the judiciary could navigate that regulatory vacuum. But let's fast forward. If this same messy situation happened today under the mature VAIR regime in Dubai, how would the system prevent this kind of litigation nightmare?
Well, a lot of the complexity that forced the court to use an expert and, infer intent would be replaced by regulatory precision.
So if a VASP, or virtual asset service provider, handled this,
the transaction would likely fall under VA management and investment services from the VARA regulations of 2023. And the primary fix is the requirement for a comprehensive client agreement.
what does that agreement do?
VAR rules demand that it explicitly defines everything: the assets, the risks of fluctuation, the rights of each party, and most importantly, the exact consequences of a default. It's designed to eliminate the very ambiguity this 2021 court had to wrestle with.
And it also prevents the sort of informational vacuum we saw where the defendant just disappears.
Absolutely. The transparency rules are strict. VASPs have to provide monthly statements detailing all asset values and transactions. Plus, federal rules mean custodians have to notify clients of operations within 24 hours. You get this robust, regulated audit trail.
It makes it almost impossible to argue about whether a default even happened.
Right. And if we connect this to the bigger picture, the most critical mechanism is VA's requirement for what are called default rules.
Default rules.
Yes, the VA Transfer and Settlement Rulebook of 2025 mandates that all VASPs have these legally enforceable rules. They have to define what a default is and then outline a probable sequencing of actions to follow.
So VAR is essentially forcing the industry to pre-agree on the damages clause.
In a way, yes. It takes the complex role of the court-appointed expert out of the equation for future cases. These rules must include the closeout of positions. The whole remedy is structured, predefined, and contractually accelerated. It's designed to replace that long litigation process.
Turning years in court into a matter of days.
That's the goal.
This brings us perfectly to the last part. Preventative measures. For commercial parties operating outside that regulated space, what's the practical guidance from this judgment?
I mean, the ultimate goal is to create a contract that basically executes itself. And you start with a robust transaction characterization clause.
Spelled out in plain language.
Plain language. Explicitly define the deal as a forward contract for the physical delivery of digital assets. And you even state what it's not. It is not a loan, not a partnership, not a joint venture. This frames any failure to deliver as a clear breach of a sale.
And beyond just the label, you need precision on the assets themselves and how they're valued.
Absolutely. Use granular definitions, reference the unique blockchain protocol so there's no argument over, say, a hard fork, and crucially, pre-select a binding valuation source and timing. You call it a reference price.
For example,
the contract could say, the price will be the mean average on Binance and Kraken at 1200 hours UTC. Suddenly, disputes over valuation they melt away.
That makes the financial calculation mechanical. But what about the proof? How do you make the proof of performance technically solid?
You define a confirmation protocol in the agreement. For instance, the contract could state that a transfer is only considered complete when it's recorded on the blockchain, plus a minimum of 6 subsequent blocks have been added.
So that prevents the classic dispute where someone claims a transaction failed or wasn't final.
Yeah.
You're aligning the legal idea of delivery with the technical reality of blockchain immutability.
Exactly. And all this leads to the ultimate risk mitigation, pre-specifying the remedy itself.
The closeout provision.
The liquidation and closeout provision. It lets the non-defaulting party immediately calculate a net termination payment based on the market cost to go out and acquire that undelivered asset at that moment. It achieves the same result as the court,
Compensating for the lost opportunity.
but through a self-executing contract. It saves years of time and enormous legal costs.
So, to summarize the key takeaway from this deep dive, this 2021 judgment is a powerful affirmation. UAE courts will look past the title of a contract, like loan, to enforce its true speculative nature, and they will award damages for lost appreciation, as long as the terms are clear enough for an expert to calculate.
And this brings us to the author's bridge. The key here was that there was a written contract. It was flawed, but it was essential. It gave the court and the expert a basis to work from to find the true intent.
The ruling in this 2021 case is a powerful example of the Dubai courts looking past the formal title of an agreement to enforce its underlying economic substance. By awarding damages for the lost appreciation of Bitcoin, the judgment affirmed the speculative nature of the bargain, even though it was documented as a simple loan. The existence of a written contract, however flawed, was essential, providing the expert and the court with a basis to determine the party's true intent. This stands in contrast to the frequent reality of the crypto asset space, where ventures often proceed with no formal documentation at all. This absence of expressed terms forces the judiciary to infer the nature of a relationship from limited and often conflicting evidence, such as bank transfers and witness testimony. The next judgment from the Abu Dhabi Court of Appeal addresses this exact scenario. It provides a crucial insight into the default judicial posture where, in the absence of a clear partnership agreement, an investment of funds for crypto trading may be treated not as a speculative venture with shared risks, but as a simple transfer for which the principal is fully recoverable. That brings us to the end of our discussion on Chapter 5. This chapter's structure is the standard methodology used throughout the book.
Authored by Mahmoud Abu Wassel, and drawing on analysis from over 100 judgments, UAE Crypto Litigation serves as an indispensable resource for those in the digital asset industry.
To read the full analysis for this chapter and to explore the complete 7-part life cycle of a commercial dispute covered in the book, please visit www.uaecryptolitigation.com.
The discussion in this podcast is for educational and informational purposes only and does not constitute professional advice or any other professional relationship. Please consult with a qualified professional for advice tailored to your specific situation.